Daianu is the former Minister of Finance of Romania, has been a member of European Parliament, is member of the board of the Central Bank of Romania, and is professor of economics. And as I was mentioning, the wealth of experience, of angle of vision, and so forth, having the Minister of Finance on the one hand and being professor of economics whilst knowing what central bank is certainly a big privilege. You have the floor, Daniel.
Oui. Bonjour, Monsieur le Président. Ladies and gentlemen, I'll try to present some views of mine on why is it so complicated to see the light at the end of the tunnel, and I'll focus on ultra-low interest rates and the unconventional policies which are epitomizing the challenges for central banks and governments. I will not deal with what caused the financial crisis, but I'll just mention the current context: economic slowdown, very low inflation, high connectivity, high volatility, new systemic risk, disruptions, sudden stops, liquidity traps, the new technologies and financial markets, cyber attacks, and change in business models. When it comes to the macroeconomic context, the demand side, which was highlighted by President Trichet, the Chairman Trichet, the hysteresis, which is Summer's line of reasoning, and why we need to use fiscal policy again. But I would emphasize the legacy of resource misallocation, which is frequently ignored in public debate, and which is a point made by the BIS experts: that overhang, enormous uncertainty, and its impact on investment and saving, which was mentioned by John Lipsky. And last but not least, ultra-low interest rates and the unconventional policies. When it comes to macroprudential context, unfinished regulatory reform, complexity on the rise was a challenge for both regulators and supervisors, but also for the CEOs, large entities and systemic risks, and the migration of risks, the capital markets issue, and fintech and new risks. Now, why ultra-low interest rates matter? Because they mirror large dysfunctions in our economy. Side effects, including bubbles, resource misallocation, again, what is emphasized by the BIS people, banks and non-banks balance sheets, impact on banks and non-banks impact, and we see banks in a way outraged by very low policy rates, forced change in business models, and policies befuddle, I mean, because of unconventional tools. What drives real interest rates? Many people say that it's because of central banks' policies, but it's not accurate. The drivers are demographics, income distribution, productivity gain slowdown, an educational plateau, what Bob Gordon says, global competition, the savings glut, the cost of capital, safe asset scarcity, and growth prospects are becoming dimmer and dimmer. I have a few graphs which shows, I mean, the dynamics of long-run real interest rates with shifts in desired savings and investment. Policy rates since 1970s. I mean, they are not of recent vintage, the very low policy rates. They've been on a decline trend for decades. What do central banks? Central banks are hardly behind the fall of long-term real interest rates, but they had a role in amplifying the global financial cycle, and here I see eye to eye with the bank, with the BIS. And there are two fundamental key questions in my view. Do negative natural interest rates make sense? And can nominal policy rates be negative? And in a frictionless environment, natural rates should be positive. But with large resource underuse and misallocation after a big crisis like the current one, rates can be significantly negative. And when inflation is very low, the zero lower bound bites and policies can turn unconventional. Are negative nominal policy rates feasible? Yes, they are. And there are central banks which do practice negative nominal policy rates. But they can also be used, they are a proxy for competitive devaluation, whether the central banks do declare it or not, but we can see it. But they have diminishing returns. And this is why some people advocate a return to fiscal policy activism under the current circumstances. Could CBS, central banks, engineer rises and real risk? Yes, in the short run they could, but they would trigger again a new bout of deep recession, and we have a Swedish lesson of a few years ago in this respect. Banks are under siege with more severe capital and liquidity requirements. There is less credit demand. There is ongoing balance sheet repair, and in Europe we do have a problem in this regard. There is reputational damage. There is competition from shadow banking. And there is also technological innovation, fintech. Risks abound. We can find plenty of systemic risk now in capital markets too, and the CCPs, which were mentioned by President Trichet, they can be purveyors of systemic risks. And I ask myself, well, however blasphemic that could be as a question, do capital markets need a land of last resort? Because if something really big would fail, what are you going to do? Are you going to be nonchalant and sit on the fringes, do nothing? Now, challenges, and I'll finish on this note, it's a very highly uncertain global environment. Cognitive models are under question, including the models used by central banks in their modeling, low economic growth and low inflation, disruptions. There is social strain, which articulates politically. Systemic risks abound. There are new technologies and parallel markets, and central banks have a problem in dealing with parallel markets. The Bitcoin is a parallel currency. And complexity and fragility, an issue for both regulator and supervisor. Thank you.
Thank you very much indeed, Daniel. We were fascinated by the concentration that Professor Daianu was operating, and I guess that you will have a lot of questions on many of what you just mentioned, including, of course, the today's challenges. So thank you so much. Can I ask you whether it would be the privilege of the panel to have a copy of those slides?
Yes, they're available. And I have another one on fintech and financial markets. But in my second intervention, I'll also deal with that.